Don't just sit on those gains. Use those gains productively. Debt or loans that you receive is not treated as income. Sneak peek into this video, we're gonna talk about how the wealthy use this strategy in order to avoid taxes, how to borrow against your stocks to buy real estate, how you can do the exact same thing in a low risk way to go out and buy real estate if we don't have the current capital we need to buy real estate. So stay tuned through this entire video. It's gonna be action packed, and we're gonna get a lot of secrets that the 1% know about real estate investing right here in this video. With that being said, let's dive into this video's content, how to borrow against stocks to buy real estate. What the 1% do is they invest their time and their energy into building assets, okay? The assets could be stocks, the assets could be businesses, the assets could be real estate, okay? So when I say assets, it's one of those things, okay? If you have those assets, and let's say the value of those assets for you is $100,000, and let's say that you don't have any debt on those assets. So you have $100,000 of equity. Well, what the wealthy do is they focus on acquiring assets and they focus on growing the value of that asset. So let's look at the stock market in general. We're gonna do that through two indexes. We're gonna look at the S&P 500 and the NASDAQ, okay? So those two sources, those two composites rose 26.9% and 21.4% respectively in the year 2021. So if you had gone into the year with $100,000, you're coming out on the other side with $120,000. Now, the problem is that you made $20,000, but you don't actually get to use that money because that money is still tied up in the value of stocks. If you want to go out and you want to actually spend that money that you made from your investments, you have to sell the stocks, and as a repercussion, you have to pay taxes on those gains. If you hold it for less than a year, then you have to pay short-term taxes, and you have to treat that like it is income. If you hold that for more than 365 days, then you can treat that as long-term capital gains and you can pay a lower tax rate on that, which is great, but you still have to pay taxes, which is no good. As a wealthy individual, what the wealthy do is they never sell. If you look on, the Forbes list, you'll see everybody on that list is on the Forbes list because they own something, because they've built something and they've retained ownership. So let's say, for example, that we're on the Forbes list, and let's say that we're worth $1 billion. We built $1 billion company. Now, if we wanted to go out and we wanted to sell that business and bring in $1 billion, we're gonna pay 20%, somewhere around there, 15, 20, 23%, depending on the person where they live and all that good stuff. They're gonna pay that much in taxes, which could be $200 million, and that's big. Now, they still have $800 million, and that's fine, but what they do instead of that is they say, hey, I need $50 million in order to live. So instead of selling $50 million of stocks or a piece of their business or whatever it is and having to pay taxes on that, all they do is they go out to a bank or a lender and they say, hey, I have these assets that are worth $1 billion. I would like to get some money. I don't want to sell these. I have this value, I have this equity, but I can't spend that, right? You can't go down to, your local grocery store and pay in stock. You have to pay in cash. You have to pay in dollars. So what the 1% do that most people do not is they never sell, because they're going to continue to focus on investing their money, their equity in places that's going to continue to grow at a high rate, okay? And so what they do instead is they just borrow against that. And let's say that they can borrow at 3% against the value of the assets that they have. So they go and they need $50 million to live, and they have $1 billion of value. So no problem, they can go borrow against that. And what they're gonna do is they're gonna turn around and take that debt that they got, and they're gonna live off of that debt. And because the internal tax code is set up like this, debt or loans that you receive is not treated as income, okay? Because you have to pay it back, it is not technically income. Whenever that money comes into their bank account and they know they're gonna have to pay it back at a future date, it's not treated as income, but they can spend that money, they can spend that $50 million just the same as they could if they had made that money. They can spend it the same, but it's taxed differently, okay? And so here's where it gets good. If they're gonna borrow, let's say $50 million and pay 3% interest, as long as the asset that they have continues to grow at a higher rate than their interest rate they're paying. So if we're paying a 3% interest rate, as long as our assets are growing at 3% or more, then really the loan has no cost to us whatsoever. It has no cost to the wealthy individual who's doing that. It has no cost because the value of what they borrowed against continues to go up at a rate that is more than the interest rate that they're gonna pay to whomever they borrowed the money from. Okay, so that is a huge secret that, again, it's secret. It's not really a secret. It's written. Everybody can do this. And we're going to talk here in just a second about how you can do the same if you own stocks. It's genius because you're going to hold on to that asset with inflation is going to continue to rise in value as long as you feel comfortable that the cash flow, if we're talking about real estate or if we're talking about dividend paying stocks, if we can own something that cash flows or a business that cash flows and pays us dividends in order to pay for a loan, well, that's even better because then it truly has no cost and we're using somebody else's money to live our lives and continue to build equity and value and net worth in our lives. And so how can you do the same, but I want to put a spin on it. Instead of saying, hey, how can we go out and how can we live our life? How can we use that to acquire more assets? And so it's just the same. If you're a real estate investor, you've ever heard of the BRRRR method? It's the same exact thing where we want to go buy real estate, we want to add value, and we want to refinance all of our money out, and then we want to repeat, right? We want to do that again and again and again as a way, as a method to get equity, to get cash for our next down payment on our properties. And so if you are just getting into real estate and you've been in stocks, or if you're doing both at the same time, the way that most people invest in stocks is to just pay for all cash, right? Whenever we're buying real estate, it's very, very common to go out and to get loans against real estate and to buy at 70 or 80% leverage. But most people in stocks just buy stocks with 0% leverage. So if you have a $100,000 stock portfolio and you have no loans against it, it's the same thing as having a $100,000 rental house or rental property that has no debt on it. And you can go and you can get a refinance on it. Now, the mechanism is going to work a little bit differently, and that's what I want to talk about. There are two ways that you can actually buy or you can borrow against your stock portfolio. Number one is a portfolio loan, which is an actual loan. Number two is a line of credit. And a line of credit is where, hey, whenever you need this money, you can draw this money off of your loan, but you don't have to draw it all right now. And then a loan is actually, hey, here's the money now today. You're actually drawing that money off of that loan. And so that's the difference. It works just the same like any other loan or line of credit for, a home equity line of credit or a home equity refinance, okay? And so here's a little bit of the difference though, is that whenever we're going and we're borrowing, let's say, a refinance against our personal home or an investment property, there are terms set on that loan. The terms of that loan generally are, hey, it's this percent interest rate for this loan. It may be a 4% interest rate for 30 years, and here's your monthly payment. You send in your monthly payment and you are fine forever. Okay, like as long as you make your monthly payment, you do not default on this loan and you are good. Now, if we're taking out a loan or a line of credit against our stock portfolio, generally it's going to be tied to the value of our stocks. And so as we all know, stocks are much more volatile than real estate. Particularly, each individual investor's portfolio is going to be different and unique. Investor A may own 1,000 shares of Apple, 1,000 shares of Amazon, 500 shares of Walmart. Well, this investor over here, investor B, may own 5 shares of 500 different companies, right? And so their values of their portfolios can fluctuate differently, and that's going to impact how they borrow against that. All you need to know is that you don't want to go borrow. You can get up to 70% loans. Okay, and it's also sometimes called margin, borrowing on margin. And you can go and you can get up to 70% against your portfolio, but that's really risky because you have to maintain a certain margin. You have to continue to have a certain amount of equity inside of your portfolio. So you want to have a game plan on how do I get out of this margin that I have against my stock portfolio. Because if the stock market goes down, let's all hope it continues to go up. But if it goes down and you're outstanding, you have to find a way. It's called a margin call. You have to find a way to get the money back into and pay down the loans to meet that same percentage. So let's say that you had, at the start of 2021, you had $100,000 and you had borrowed at 70%. That would be $70,000. And let's say it continued to rise at, let's say, 20%. In 2021. So at the end of 2021, you had $70,000 borrowed, but you now have 70% of an additional $20,000 that you could borrow against. And so quick math is going to tell me that's an extra $14,000 you could borrow. So now you could take your total borrowed amount up to $84,000. Well, let's say in 2022, we have a big drop, okay? Let's say like the second round or fourth round or whatever round we're on, of this virus causes the stock market to go down. And now your value of your portfolio goes from 120 back down to 100,000. So all of your gains were wiped out. Now you have still borrowed and have outstanding $84,000 and you need to get no higher than 70%. Let's say that's the max you could go at. So what's gonna have to happen is your broker or whomever you've borrowed from is gonna call you and say, hey, you need to deposit an extra $14,000 to bring your balance back down to $70,000. And so if you don't have that $14,000 to pay, they're gonna force you to sell some of your stock in order to get your ratios right, in order to pay off your debts to a place where they feel comfortable about how highly levered you are against the assets that you've pledged as collateral. And so you never want to borrow up to that maximum amount against your loans. You always want to play it safe. I'm a very conservative investor, and I think you should be too, especially when playing with that, is you never want to borrow, let's say, more than 50%, because even if your stock portfolio drops, you're not going to reach that ceiling and you're not going to be required to make a margin call. I think that borrowing against assets you have to acquire more assets is great, especially whenever you're borrowing against assets to go out and buy real assets. They're going to produce cash flow. They're going to help you on tax benefits, aka you're going out and you're buying real estate. And I want you to buy value add real estate, because value add real estate, what I want the game plan to be is I'm going to borrow this money against my stocks. I'm going to go out and I'm going to buy real estate. I'm going to use this money as a down payment. And then I want to add value to this property, and I'm going to go do a refinance. And I'm going to get all that money back out, and I want to pay off the money against my stocks. And then I want to do it again whenever I have another opportunity. And not only do I want you to do it, with your stock portfolio as an asset, but I also want you to do it on this other property that you've already bought. As that property's value continues to go up, as the debt continues to go down, you're gonna again have the ability to do the same thing, except not against a stock portfolio as an asset, against real estate as an asset. And what that's gonna allow you to do is to get into safer, longer term debt that has no risk of being a margin call. Because if the value of a house, again, let's say, we had a $100,000 house going into 2021. At the end of 2021, let's say it was worth $120,000. Let's say the value rose just the same as the stocks, which is probably true. In a lot of cases, it might have rose more than that. Where I live, the average value of a house rose 27% in 2021. Pretty incredible. Okay. And so again, I could borrow against that, but the difference is once I borrow against that, as long as I never miss a payment, let's say the housing market goes down, I don't have to pay I don't have to make some huge amount of payments in order to bring my debt levels down because my asset value dropped. In real estate, as long as you continue to make your payments, you're always going to be safe. And that's as long as you don't have a balloon coming up. Try to avoid, short-term loans in real estate that have to be paid off 3 or 5 years. I'd look for 7 or more years, or fully amortizing loans, okay? And so if you have stocks that are just sitting there, especially if they're they don't pay dividends, right? Some stocks pay dividends, some stocks do not pay dividends. If you've had huge gains, okay, you can use those gains. Don't just sit on those gains. Use those gains productively, okay? Because if you just let gains sit there, you're missing a lot of opportunities out there in the real estate world that could continue to grow your gains and your cash flow at an exponential rate. And so that's what I have for you guys. I personally own $0 in stocks because I do not like the stock market. I prefer to keep all of my money in real estate. I love helping other people buy real estate. That's why I give this book away absolutely free. If you want to learn about real estate, the link to that is in the description. And I also put together, if you're like, hey, I do have stocks, I do want to get into real estate, but I don't know the game plan for going out and finding deals, buying deals, putting deals together, adding value. I have a webinar called How to Acquire Your First Investment Property in the Next 90 Days. It's like an hour-long training. And if you want to join that, it's, again, absolutely free. I just want to help people buy real estate. It's my personal mission to help 1,000 people buy their first investment property. I'd love to have you subscribe to this channel because I'm going to put out more content every single week on how to actually make progress as a real estate investor. Thanks for tuning in. Check out some of my other videos, and I'll see you next time.